Yeah, hello, welcome to the last panel today. I see still some people here, so that's great. We're trying our best to entertain you. So we start with first with a quick round of introductions. We have here Mohamad Zaraket from BNY, Head of Digital Asset Strategy, EMEA, for almost 5 years now. Has been with BNY a while longer than, and came from the sector of innovation and digital business there. To his current position. Then next we have Martin Onyeador, long-term employee of NatWest, now with digital capital markets there as well as the bond syndicate. Next one is Dirk Kruwinnus, has been with Group Börse Stuttgart almost as long as I've been with the FAZ, and moved a year ago to be Chief Product Officer of Seturion. And last not least, my namesake Christoph Hock, share the same family name but not related. Had several stations in the asset management industry and is now head of tokenization and digital assets of Union Investment. Great. Our topic is the European DLT stack. Now that's a real huge topic and we might talk for ages and it might not get us anywhere. So the title gives us a hint what it really is about. The path to scale, the path to grow, the path to becoming a significant factor for the capital markets. But for what? What is it really that we're trying to achieve? And Mohamad, first introductory question to you. Would you be so kind to share your vision with us? In what kind of world will DLT lead us with regard to the DLT stack?
Yeah, thanks for this, and good afternoon or almost good evening already. So really what we are focused on as BNY, first and foremost, really, if you look at this, what we play in is in the infrastructure side. And naturally, we're looking at the evolution of the capital market to ensure that it is becoming efficient, more efficient than it is today, more liquid, and then importantly, as we look at building the new or the future generation of capital market and evolving this market, ensuring it's a seamless experience as we move to the next phase of this. And if you look at that as from where we come from, our point of view, you then look at what are the trends and the things that are happening today that is ultimately will allow us to play in that space and arrive and achieve that vision. And from that perspective, there are a couple of things that are happening today that is really driving ultimately our roadmap to where we want to arrive. And a couple of those things have already been called out earlier, but in different panels, but I'll share a few of those. Today, we think market is already moving, capital markets already started to move at speed, and that speed and certainty of settlement is becoming very important. And we want to ensure the infrastructure of where that capital market is operating is actually fit for both purpose, including for the future. So that is really one trend we are focused on capturing that is driving what we're doing. But then there are a few other things that has been happening that will enable us to move forward. And at core, if you look at a few other things where like what I mentioned being called earlier, for example, is the markets has already started to move from pilot to actual adoption. It depends in which area, but there are different areas where we have already moved from that pilot phase to adoption, and that is in itself a good driver. And this is just telling you that actually markets started to understand the benefits of this technology. And as such, what it actually enable. And these are the different things that has been brought after, whether it's about liquidity, distribution, efficiency, etc. But that is still the early inning of that, because more needs to be built, which we will speak about it. There are use cases that are already scaling, or we're seeing an acceleration on these areas. And in particular, I'd say the cash and cash equivalent. So that is the digital cash and cash equivalent. And when we're speaking about that, we're really talking about stable coin, tokenized deposits, tokenized collateral, and tokenized treasuries, or any form of sovereign bonds. And that in itself, and the reason we started to see that scale, and as such we're focusing on supporting and enabling that, is really because, one, apart from just the efficiency and play, it's also about bringing in new use cases that you today could not enable with the infrastructure that exists today, or you could not even envision. Now you can start to look at bringing these use cases or solution to something you couldn't have in the current setup. As an example, a tokenized money market fund, posting it for a collateral use case or margining, or even using a stable coin, which is your cash, for a settlement leg of a securities. And so we're also focused on enabling all of that from an infrastructure perspective. And maybe just concluding, certainly underpinning all of that is the regulatory clarity, and the more clearer the regulation, and to the title of this panel, and there has been an evolution there that's act as a catalyst that will enable us to move forward to where we want to arrive.
So, great vision where we have to go, and as you pointed out, we're on the road there. Dirk, I would like to ask you, we're on the road now. How far have we come? Can we look back with satisfaction and say, we've come such a long way, we're on a good way, we're nearly there, almost there, or would you rather say, oh, it's such a long way to go?
Yeah, so thanks for the question, and first of all, thanks for the audience still having the energy to be part and participate in our last panel here. So, you know, in Swabian, where I'm coming from, there's a saying, what you have paid for is also eaten. So obviously, either there are some Swabians in the audience, or at least you have Swabian behaviors and habits. So thanks for that. Thanks for the question. So with regard to the question, more or less, is the glass half full or half empty? So to be honest, we have decided already 3 or 4 years back in time that the glass is half full. So otherwise, we wouldn't have taken the decisions to invest and to build up an infrastructure for the DLT financial instruments. So looking at the class today, it's way beyond half full. So we see, and that's not because we believe it's more than half full, but of course we see the developments in the market. We see the ECB with Pontes and Appia. At the end, it's a statement that DLT will become a core infrastructure and technology for in the T2 world. We see on the other hand the EU Commission with the MIS package. Also there, DLT is dedicated, one of the new core technologies, be it within the DLT pilot regime, but also be it for the CSDs, which now are then with the MISP enabled to use DLT. And so we see throughout the market the banks involving and building up the infrastructure on the custody side. So we see the whole market going there. Mo already told us his vision. And so, yeah, it's definitely more than half full, and we're on a good way.
That's great. Well, so we can just sit back, wait, and relax, and we might just draw close here. No, I don't think so. No, Christoph, would you say? We are on a good way, and Mohamad's vision will come to pass anyway, or do we have to put more power on the road still?
Yeah, definitely. I'm a strong believer that the glass is half full and not half empty. I think when comparing it with a marathon, for the last couple of years, we went about 10 kilometers uphill. And now we have the remaining 32 kilometers, and it's going down the road in a speedy manner. So I think we are pretty close to the inflection point. I mentioned it this morning in a panel, to the kind of ChatGPT moment in DLT. I think it's kind of normal when looking at technological transformation that you have initially a fairly slow adoption, and then you get into a hockey stick. Looking at the upcoming of the internet in the 80s and in the 90s, there was first also very high level of skepticism, and then at one moment there was no way of return at all. Similar to looking at Web 2.0, look at platform technology, Amazon, look at social media. First, very slow adoption. There was a questioning, why on earth do we need this kind of technology? Everything is fully operational, it's fully working. Why should we have any change? And then out of a sudden inflection point, bam, exponential growth. And I'm a strong believer, same will happen here also on when we're looking at DLT. It's important to see that we do not implement DLT measures for the sake purely because it's a sexy technology. We want to solve problems. We want to improve services, even further improve services we deliver to our end investors. We are a servicing industry, an exchange has its clients, we as Union Investment, as an asset manager, we have our investors, same for the sell side firms and same for BNY as a custodian. And the key question is what's in it for the client? Which problems do we want to solve? Which situation is it we want to improve? And as Mohamad was alluding to, it's about tokenization, the new standard going forward, point number one. Point number two, 24/7 trading. Point number three, near instantaneous settlement. And all this will lead to a significant change, beneficial change of client behavior. So as a retail client going forward, you might have your app where going forward your tokenized securities, your digital cash, all your assets are in one app, and you do not have to flip to your savings bank to see what's my cash balance right now, to another app where you have your fund shares in, and a third app probably you have with a bank where your stock positions are shown. And I think that's really user convenience when having everything on one platform, having due to 24/7 trading and near instantaneous settlement, permanent accessibility. So as an end investor, regardless whether it's retail or institutional, going forward, you will sit permanently in yield-bearing assets, and when you want to make a payment transaction, you just instantaneously convert this position into digital cash to start the payment process.
I'm looking forward for that day when it really comes to pass, but we have to, I think, tackle some issues before, and this is now the task at hand for us to single out these issues and to talk about, well, when I think of it, especially when it comes to asset trading, the first foremost thing that I feel is amiss is liquidity. So it's all very nice. We have some marketplaces, do some trading, do some pilot trading, we do some regular trading. Yeah, but it's not really a marketplace, it's marketplaces, and it's small marketplaces. And so I'm asking myself, we have to get this all together, but when we look at Europe and traditional financial markets in Europe, we have a lot of fragmentation still there. Everyone's talking, I mean, even our Chancellor is talking about the big European exchange, which we're all waiting for, and nobody's really interested. So what is it with DLT? Do we might run into the danger that everybody does their own stuff, and in the end, because it's good for everyone, it stays that way? How do we get this together if maybe a lack of interoperability, and this is where I'm aiming at, is a means of a market entry barrier? Or am I here completely off topic? Martin, what do you say?
Firstly, good evening, everyone. Hope you're still awake. I think in terms of, say, the DLT stack and the interoperability, I think it's really key. Again, I guess my background is more on the sort of digital security side of things. And a lot of these cases we do talk about is, again, collateral management. But one of the, I guess I'll probably say three things. One of the big things we need to address is collateral eligibility. Now, we had a recent announcement from the ECB saying that CSD DLT securities would be eligible for collateral in the US system. That's fantastic news and is a great step forward. However, the reality is that we do need to think about the non-CSD DLT platforms who are out there innovating, taking risks to be in this space. And essentially, we need to move to a place where we can codify what exactly do they require for those securities to be eligible for collateral. And that needs to be, if you ask me like the number one thing, I'll say absolutely that. Focus on that, because speaking to the buy side, typical thing they'll say to you, we've got this bond coming through, is it eligible for collateral? No, I can't use it. Buy, end of story, right? That's the conversation starts and ends very quickly. And so we just need to make it so that it's balanced in terms of who the market participants out there. So again, the non-CSDs also can essentially catch up. Ideally, I don't want to wait until 2028 of when that's going to happen. So this is something that I think we all need to push and strive for. Again, and the other thing, obviously, when we think about interoperability, talk about harmonization of standards, and again, maybe from a European point of view, we're looking to see what Appia will do. We're really keen on what Pontis will do in the short term, but Appia is really the full-time goal for the real vision of digital European capital markets. And as part of Appia, we must think of how, when we think about the asset, the token itself, and the protocol related in the space, we need to think about how can we create those standards, right? And as much as the title of the panel is the European DLT stack, we can't, again, probably my accent, you realize I'm from the UK, that this can't be a European-only sort of view. We have to build even just locally between our Swiss and UK friends, and more broadly to what's being done in the US and in Asia and also in the Middle East. The reality is that in Europe we can lead. We can lead here and turn the standards, and Appia could hopefully be the conduit for delivering that. However, we need to still work with our international partners to deliver, right? And now, look, I know there's different sorts of projects out there which are really important. So I know we obviously know what Swift is doing. We also know Project Goro by BIS. These are really important initiatives. The reality is that they're going to be quite kind of slow to deliver on. But then I think there's generally, when we think about crypto, and again, I'm coming from a banking side, everyone is really trying to rush into sort of deliver a solution, which I understand. But we need to make sure we build a road which we can drive on. And everyone talks about DLT being autobahn. We need to make sure there are no potholes, right? Also, this will just come up later down the line. So it's building those standards, maybe building towards ISO standards, because essentially that's what we're going to need. We're not going to get full interoperability. When I talk about moving collateral, everyone talks about velocity around the world. How do you get that if we aren't aligned internationally? So again, this will take some time, but we have to build correctly. But and again, if it means that it has to be a public-private sort of partnership to deliver on that. Yeah.
Dirk, interoperability, I think, is very much up our line. So, what's your experience? Are we going there? Are we making progress?
So I think there will be different steps. So on the one hand side, building the DLT stack, the question is how we define it and how we build it to bring it together, meaning not necessarily everything needs to be on DLT. So the first question is how to differentiate what needs to be on the DLT. Obviously, the assets themselves, otherwise we wouldn't talk about DLT financial instruments, and then necessarily also the settlement. The question is, so today's trading infrastructures are efficient. We can have billions of quotes a day. We have the connectivities and things like that. So the European DLT stack not necessarily means, in my opinion, that we bring everything on DLT, what might be possible in 10 or 15 years. but what is necessary now to have a adoption of the industry and to go step by step into the DLT stack we are discussing. And there we of course have different challenges. So as of today, we have financial institutions going for private permission chains. Other financial institutions decide for also going for public chains. So currently, we have different stacks and different DLTs that will be used. So the question is then indeed how to aggregate them and then make things interoperable. So that's the steps we have to proceed on, but that's somehow the market needs to go and find its way, and might be at the end then nevertheless 2 or 3 dominating chains, and then we additionally with standardization coming from not only ECB but also from ICMA or from standard setting institutions or the industry coming together and saying, okay, that's the token standard. So and that will be a process to guarantee that interoperability and then to make the stack on the one hand side as decentralized as possible, because of course there are a lot of advantages not having everything centralized. That's the idea of the whole story. And on the other side, then nevertheless to have an efficient ecosystem so that not an issuer or, for example, Christoph does not need to be present at 10 chains because the things he wants to invest are divided in different chains. On the other hand, the sell side need to issue in different chains. So that's then the step towards a integrated setup we are heading for.
Yeah, maybe just some minor addition, and totally makes full sense, I think. But as we look at addressing the point around interoperability, and there are a lot of initiatives happening today, and you've alluded to a couple of those, including Swift and Agora, etc. But there are also steps that are in between that can happen today, so we can start reap the benefits. So, for example, in how different players might be connecting, even including bilaterally to start already, especially if there's already multiple use cases happening between those bilateral players, but ultimately want to arrive to multilateral plays. So different players already connecting in one shape or form, especially regardless if it's a private to private and then private to public, but to start basically reap some of the benefits that this technology bring if there are already a scalable use case that's already in demand. That's one. And then the other piece is about how do you connect, and there are many ways also to connecting, but some of those also you could look at leveraging what already exists to connect your traditional, your internal environment to an external environment in a way that is before everything else is built. Like take an example. We as BNY have our own tokenized deposits internally, but that's for BNY clients to consume. But tomorrow, if we have a client that want to buy a tokenized fund on a public blockchain, there is a world where you can leave our ecosystem, using a stable coin to go and buy that tokenized money market fund in the public chain. So it's not necessarily day one gonna be the most efficient way, but still that's saving you a lot of time versus maybe just doing everything in the way that is already existing today.
Maybe to add, Martin, I think it's an interesting discussion whether fragmentation by definition is bad or whether fragmentation could be at certain levels of time helpful for the market. To share an example, in the TradFi world, when we implemented MiFID I in the equities world, this was back in 2007, 2008. Prior to MiFID I, we've had typically stocks traded at one, national stocks traded at one exchange. So Xetra had a market share of 90% plus, LSE had a market share in the UK of 90% plus. And when looking from an investor's perspective, this came with extremely high cost. So we've had about, when trading stocks, we've had about 50 basis points in cost. Nowadays, MiFID I was really chasing competition. The traditional exchanges, the national exchanges, they have market shares of about 50, 60, 70%, which is still good enough for the price formation process. but there are a number of competitive venues around, and today when we trade equities, we pay about 2 basis points. You have, via algo trading, you have connectivity to all 20, 30, 40 different venues in the market to fulfill best execution at a very high level. And I think this illustrates that competition, fragmentation also leads to a very high level of innovation and is a driver for costs significantly down. And what we've had in the equities world after that was after the fragmentation, a kind of consolidation again, and you have 1-2 handful of key exchanges right now. And from my perspective, we will have similar involvement in the DLT space. Would it be a positive outcome to have one chain the entire world agrees on for cash and assets on chain? Clear answer is no. I think, as Dirk was alluding to, we might end up with 5, 6, 7 dominating chains from a global perspective. I think central banks, they are probably more in favor of private chains, looking at the private sector. The route of travel is more towards public chains. And I think it will be a kind of coexistence. And for the end investor, and I think that's most important, the outcome in this environment isn't the very best one because, again, competition drives innovation, brings costs down, and it's important to have a highly resilient, robust framework because financial market stability is a key asset we as an industry have achieved over the last 20 years. And even going into a DLT world, that's definitely an asset we do not want to give up.
Great pledge for the merits of competition, I'd say. Well, let us talk a little about the control plane. Europe, we have put a lot of emphasis on who may do what and how is all controlled and audited. Not by chance did the EU have the first ever regulation with MiCA. Is that a helpful approach, or are we in danger of losing out? The other way is do things first and think about regulation later. EU is a bit the other way around. How far have we come anyway? Given this question to all of you, whoever wants to go first.
I can kick this off. So, I mean, on the regulatory front, I mean, first we look at this, certainly it is an enabler. Until recently, we've been looking, and the last few years, if you see where we started, and to the earlier point we were talking about the glass half full. I mean, a few years ago, in many places, we did not have any type of regulation around this regime. Having said that, there has been a lot of innovation that started to happen. And as we started to learn, I guess, from one side, and the market started to see the benefit of this whole technology, the regulators started to open up and look at what can be done in order to enable this. Certainly, clients, in order to spur adoption, you need to have clarity, because without that regulatory clarity, adoption would not come at scale. Having said that, the early innings of what's been happening has driven us to arrive to where we are. So MiCA in Europe, which was the firm, such a level framework that is bringing such a clarity around crypto assets at the very least and stablecoin, has started started to bring that additional adoption, because now we started to see clients coming forward and players across the board who want to bring forward their services to service this industry are clear on what can be done and within which controls they can operate. So for a BNY or other clients we're talking to across all segments, they are very much they are viewing this, of course, and us as a very positive part of the puzzle. But of course, that's not the only thing. That MiCA is one, but the other piece is there are many other regulations still needs to be to evolve as we look at all type of assets that we are looking at bringing forward to ensuring that there is no different regimes Even within the EU, that's also a key, because if you look today where the regulation is as it relates to tokenization of assets, you see there's advancement in Luxembourg, but not necessarily in every single other regulatory place. And even though the direction of travel is going in the right direction, then taking this from a scale, we need to look at the rest of the world, what they are doing, and how can we ensure that there are some harmony in this regulation that are opening up, but certainly we are going in the right direction. Genius Act in the US is an example. We'll expect the Clarity Act potentially to come this year, so that will be also a key opener, but then also the other jurisdictions, like what we're seeing in Abu Dhabi and Japan and a few other places. I think certainly we're in the right direction. Coordination is key, but we certainly come quite a bit since when we started to speak about this more than 7 years or 8 years ago.
I'll make one small point. I think it's to touch upon what Mo said essentially there. What we have in Europe is, I guess, we probably need more regulation and less directives, because what happens essentially is that, to your point about the Luxembourg scheme or all the different, you have the national competent authority also opining, and that's where there could be differences between how, say, France and Luxembourg or whoever, look at some of the directives. And that then leads to, again, the issue, again, we're talking about standardization. We need harmonization, or even on legal and regulatory side of things. And I think that's one thing we probably need to address on that side too. When is the NCA? When is it, is ECB? Do we need actually more simplify? Generally what we think about growth strategy in our place is how do we simplify things? That's what technology is supposed to bring. That's what digitalization is supposed to bring. Do we just make ESMA the regulator for everything instead of it potentially being piecemeal between all the different elements? I think that's something which needs to be addressed too. So again, simplify things, and so we can just go to ESMA for everything instead of, when do you go to, Bank of England, or when do you go to Bundesbank, when do you go to, and then some things are ECB led, some things are EC led. It's just a bit confusing. Right? That's where you need standardization or simplification.
Just one additional comment. So I think the questions on the issuance of DLT financial instrument is not coming up due to DLT, that there are differences between the jurisdictions in Europe. So we have already in the traditional regime, we have for the issuance of securities, it is national law which is applicable. So now it becomes more and more obvious, because on top of the traditional issuance process, now the jurisdictions have, one of Austria do not even have any law for issuing DLT financial instrument. Germany has it with the crypto security registrar. In Luxembourg, it's the control agent. In Italy, we have also some kind of a registrar. So I think there's two levels. So the one level is, and that's not only a question of DLT. Is it sensible, and do we need some harmonization on the issuance part across Europe? And then that might be implicitly also be relevant then for the DLT. And then you have the on top layer, what is already handled on a European level. That's the multilateral trading and the settlement behind. And there we have this the initiatives already. We have the pilot regime that might be extended. We have within the MISP the possibility also for CSDs to use DLT. So there's the movement in the direction. We have this innovation on the regulation is perfectly there. We have now the clarity also beyond pilot regime. And so the path for scale is, we can't say, it's missing the regulation, missing secondary markets. No, secondary markets are also coming. So it's now also to, on the bank side, that we have scalable infrastructures. We see all the issuances so far we have, that's more or less also, of course, POCs. So the question is, are these infrastructure on the banking side already prepared for today's frequent trading on be it bilateral or on multilateral exchanges or venues. So is that infrastructure already scalable, and then bringing the pieces together, that will be the path to scale, in my opinion.
Also happy to comment on regulation, Martin. I think when looking big picture at our industry, trust our investors have in banks, in asset managers, in infrastructure providers is the biggest asset we have in our financial industry. And that's definitely something we shouldn't put at risk. And therefore, it's a very fine balance you have to draw between, on the one hand, assuring financial market stability, protecting investors, and on the other hand, to allow as much as possible innovation. And I think here in Europe we are in general on a very good path. The Americans, you were just mentioning it, they go exactly the other way around. First, they let the industry do whatever they want to do, and then when there's a major blow up, they start to regulate. And I think it's not really coincidence when looking nearly 20 years backwards at the Lehman crisis, that the source of origin was not Europe, it wasn't Asia, it was US. When looking in the crypto world at the biggest fuck up we've had, FTX, which was the kind of biggest hedge fund on earth at this point of time, it happened, not really a coincidence, in the Americas. And I'm sure an FTX here in Europe never ever would have happened. And therefore, from an investor's perspective, I think it's absolutely the right path we are on. Sometimes potentially a bit more flexibility should be required. We talk about to share details about thresholds for the DLT pilot regime we need to implement fairly soon, not to lose out in the competitive race. We have some modifications of CSDR, which are also part of the MISP package Dirk mentioned. So sometimes a bit more speedier approach would be appreciated, but as said, from a very big picture perspective, I think the European model for the entire industry and especially for investors is the more appropriate one.
Thank you. Well, as there still are a few people here, and I would like to give you the opportunity, if maybe there's one question on your mind you would like our panelists to ask. So if anyone, it's now your chance to have a go there. If not, that's just as well. So, yeah. But I still have some questions. So let's turn to the digital cash. We've seen strong movement last year. From what I've heard, there's strong interest in tokenized money funds. We have that, the money market funds. We have had that issue 2 panels ago. But what yet failed to materialize is the euro stablecoin. Does it have a chance, or is that not a concern? What would you say? Whoever wants to tackle that question.
Super. I mean, first, maybe more globally, when we look at digital cash and cash equivalent, that is what is currently where we think there is a big growth. And that's what we're seeing anyways the market is moving. We've estimated around, as BNY, we put a paper out there just in November, we've estimated like by 2030, the cash and cash equivalent market, and specifically digital I'm talking about, is going to hit around $3.6 trillion, which composed of stable coins, tokenized deposit, but also tokenized money market fund and treasuries, because those ultimately will also operate like cash in one shape or form, and that's what we're calling them cash equivalent. It's now turning to Europe. We've already started to see the demand in Europe and fund managers bringing forward tokenized money market fund or planning to do this. So there's already there's an already movement. There is already a demand and also a recognition that there is a need from, and also a demand from underlying clients who are interested in this digital cash version, if I'm going to call also including tokenized money market fund, and for multiple reasons. One is certainly a distribution to capture the digital native clients, but also for use cases which we spoke a lot about earlier. On the stablecoin in particular, it is no coincidence that we already started to also see a couple of players in Europe that are with Mika now is clear, that has put forward some of their stablecoin, and we started to see more and more of those coming up. Probably the very first one was SocGen's at Forge stablecoin, of which we are supporting from a reserve management perspective or custody, but more of those are happening and take place. Do we think there is an opportunity for more European stablecoin players to, or do we think there will be more of these coming? Absolutely. If you look at a few years ago where we were and where we are today, there are many more that has been issued. Now the question is how scalable this will be and how much of the global market cap of stablecoin they will capture on the percentage, because today is probably at best it's a 2% non-USD stablecoin. If you want to look at the total market cap of around $300 billion of stablecoin in circulation, that is to be seen. But stablecoin, that's one. And then two, there are, of course, we need to see what other players, like for example, in the earlier the session there was Kivalis, like these stablecoins are coming out of consortium, whether they will manage to find a space and whether they will get the adoption, given there's already connectivity to underlying clients who would may potentially want part of that. Again, ultimately going to depend on the use case, be it as a cross-border transfer, what you can, or settlement use case, but it's going to also depend on whether actually there's a need versus what today is operational, because today I can still also send a transfer to somebody else in the EU instantaneously. So that will become the other piece. And maybe just concluding there, certainly there's a place for all type of money in Europe, but the size of it, I'm not sure how big that would be. CBDC will be coming and very much needed for different reasons, including as a settlement leg for securities.
Happy to add. I think, again, it's important to ask yourself, which problem is it I would like to solve? Which kind of stakeholder is getting involved in these products? So in the US, right now you have about 290 to 300 billion dollar outstanding in stable coins. 90 to 95% is related to crypto business. Point number one, it's looking at Tether, it's also banking the unbanked ones. It's in Africa, in South America, where not necessarily you have a bank account. You have a fairly high usage. It's inflation protection. So when someone in Turkey, when someone in Lebanon, when someone in Argentina wants to have a dollar-pegged instrument because she is significantly losing out in the national currency, a stablecoin is definitely a use case. And I think these are all use cases. So crypto universe is dollar denominated, full stop. It never ever will go into the euro space. Second point, banking the unbanked, and that's what we do not really have here in the euro area, and also high inflation. Hopefully that's past the 10% we've seen years ago, and we continue with a more low inflation environment. So this kind of user groups, they are not there, and I think this explains also why 99% of stables is currently dollar denominated and not euro denominated. Looking at financial market industry, I must say. Stablecoins, point number one, they do not carry a yield. So under MiCA, by definition, they are non-yield bearing, point number one. And point number two, what you also have to see with stables, you have a potential depegging risk. So most recently, I think it was last week, a small stablecoin in the US imploded, and the stuff was losing 80% in a couple of hours. And imagine we as an asset manager, we have decent holdings in I think you would really have to differentiate between a stablecoin doesn't equal a stablecoin. So you have various formats, and MiCA is in the kind of gold plating standard. But imagine you have stablecoins and there's a depegging, and out of a sudden you lose 10, 20, 30%. So I don't want to create additional problems by making use of these payment rails. I want to sort out existing problems. I want to have instantaneous settlement. I want to have 24/7 availability, but I don't want to have issuer risk. I don't want to have the depegging risk. And that's why I think for the financial market industry, we discussed it this morning with Alex Hachmeister from Bundesbank, the wholesale CBDC in combination with tokenized deposits, which are yield-bearing again, is the more appropriate solution. And also from an asset management perspective, tokenized money fund, it was several times mentioned here this afternoon, is the kind of hot product for 26, 27. And it combines, on the one hand, immediate accessibility with, on the other hand, a yield-bearing component. And that's why I believe looking at stables, this will be really more a payment instrument. And the current business model where Tether makes $10 billion profit with 200 employees and 180 billion assets under management, I think this is really past. That's an arbitrage window which was there as a first mover's advantage, but going forward, a stablecoin will be more a payment instrument you have for a couple of minutes, couple of seconds in your portfolio. And I think stables also will become more transaction fee based going forward, rather than that the business model is you collect assets from investors and you keep interest earned in your own pocket.
Perhaps one sentence, sorry, then you can have the last one. So looking at it from a, let's say, capital market infrastructure provider perspective, so if we're looking at settlement and now having the discussion that we have different setups and different opportunities, so that's why we decided to be more or less agnostic, so that we can either settle in fiat central bank money as long as the market does not have decided on a standard, but at the end, of course, we all have the same idea that the whole efficiency gain over the whole life cycle of the instruments in the capital market will only be possible if you have everything on chain. So meaning also the cash must be on chain. If it's then a e-money token under MiCA for certain use cases also in the capital market, for example, bilateral setups, or if it's then a wholesale CBDC within Pontes or Appia, or if it's commercial bank money tokenized. So that we will see over time, and that's why it's important for us to be agnostic and to can add and be flexible whatever comes up on the cash side. So sorry now, Martin, you have.
I need to catch a flight, so it's all right.
Okay. Thank you very much for being here at such a late hour. Have a safe journey home, and yeah, and same goes to you in the audience. Thank you very much.